Hello, my name is Kaleb Grieco, and this is my AutoZone valuation presentation. I approach this project using two methods, discounted cash flow analysis and a comparables companies analysis. Over the next couple of minutes, I'm going to walk through my forecast assumptions, discount rate calculation, sensitivity testing, terminal value approaches, and how AutoZone compares to its peers in the industry. So moving into that industry analysis. AutoZone operates in the automotive aftermarket sector, which includes replacement parts, maintenance items, and repair services. The industry serves two main customer groups, the do-it-yourself segment and the do-it-for-me professional mechanics. That's going to be kind of just like automotive shops and whatnot, more professionals. And actually what the industry trends are moving towards is more of that and selling to other businesses that are automotive shops and doing the work for customers rather than the DIY approach. And that's because cars are just getting more and more complex and it's harder and harder to kind of do that work yourself. Something that makes this industry unique is its resilience. Even during economic downturns, customers tend to prioritize vehicle maintenance over purchasing new cars, which makes sense. I mean, it's a fraction of the cost compared to buying a new vehicle. And then kind of focusing on their biggest rivals, we've got O'Reilly Automotive, Advanced Auto Parts, and Genuine Parts Company. Another trend in the industry is that orders are shifting more towards online. And so it's interesting to see where that will take AutoZone, because a big kind of pillar of their business is that DIY model, and customers kind of coming in and you can get like really, really customized service, and they'll kind of, walk you to your car and tell you exactly what you need. So it's interesting to see where the industry is moving in the future. Anyways, moving on to my forecast assumptions. For this model, I forecast AutoZone's performance over a 5-year period. These assumptions are based on both historical averages and reasonable expectations for future performance. Revenue is projected to grow at 5% per year, which is slightly below AutoZone's long-term average. This is a conservative number, but I feel like their revenue historically was not really exponentially growing. It's kind of at a flat rate, so I kind of wanted to just carry that into the future. Gross margin is set at 56%, which aligns with recent performance and reflects the company's pricing power and cost discipline. EBITDA margin is held constant at 22%, and the tax rate is modeled at 25%. And those are, again, going to be taking a look at the historical numbers and kind of averaging it out and then carrying that forward. So just kind of giving it a consistent number. The EBITDA margin, I think, was just consistently straight across 22%, but the tax rate is a bit of an averaging out. And then on the investment side, CapEx is modeled at $550 million annually based on the actual CapEx levels from 2015 to 2019 for AutoZone. This reflects reinvestment in the stores, distribution centers, and technology. I calculated depreciation using a straight line method over 11.5-year asset life. And then for working capital, I used account receivable days is 9, inventory days 200, and account payable days 330. And then again, those are based off of historical numbers and kind of averaging them out and carrying them over into the future. Moving on to slide 4, cost of capital. This slide explains how I calculate discount rate or weighted average cost of capital used to discount future free cash flows. I used a risk-free rate of 4.2% based on the yield on the 5-year U.S. Treasury. The equity risk premium is set at 5%, consistent with historical U.S. market expectations. AutoZone's beta is 0.44, reflecting its low volatility and the defensive nature of the business. And then using the capital asset pricing model, I calculated the cost of equity to be 6.4%. I also included a cost of debt of 3.5%, and applying a 25% tax rate, the after-tax cost of debt becomes 2.63%. While this is an unlevered DCF model, I still included cost of debt for completeness. However, because AutoZone is mostly equity financed and because the model discounts cash flows to the firm, the debt component has minimal effect on the final WACC. The final WACC is 6.4%, which was used to discount both projected cash flows and the terminal value. Then moving into my sensitivity analysis slide. This slide shows my sensitivity analysis where I varied key forecast assumptions to test how they influenced equity value per share. Specifically, I adjusted revenue growth, gross profit margin, EBITDA margin, CapEx, and working capital inputs. In this case, the tornado chart appears flat because the valuation didn't materially change when these inputs were varied within reasonable bounds. The main reasons for this that I came to the conclusion of were that my forecast assumptions are relatively conservative and stable. So like changing them by small amounts didn't really swing anything much. And then secondly, the valuation was dominated by the terminal value, which is I think about like 75% of that the EV total EV value. And then for this one, I actually also had some trouble when I was making my cash per share graph. I actually caught a mistake in the capex. So initially, it was actually moving more, but once I kind of came back and fixed that mistake with the capex, it brought it back down, and now the results aren't as extreme, and it's not showing as much on the graph. Yeah, I thought I should address that. Okay, moving on to DCF valuation. Based on my forecasted free cash flows to the firm, AutoZone is expected to generate a cumulative $11.86 million over the next 5 years. Using a 2.5% perpetuity growth rate and a 6.4% WACC, the terminal value is calculated at $46.24 billion, which discounts to $33.91 billion today. Adding the discounted cash flows and terminal value gives a total enterprise value of $45.77 billion. Subtracting net debt of $5.4 billion, we get an equity value of $40.37 billion. Dividing that by 16.73 million shares outstanding, we get a best case valuation of $1,473.08 per share. And this valuation is based on stable long-term assumptions and matches up with AutoZone's historical financial structure. And moving on to the EBITDA multiple valuation. I performed an exit multiple valuation using the EV over EBITDA method, which is widely used in practice for mature companies. I projected AutoZone's 2029 EBITDA at $3.33 billion. Applying a 12.3 times multiple, which is the peer average, gives a terminal value of $40.97 billion. Discounted back, this results in an enterprise value of $30.05 billion, slightly lower than the DCF, but still realistic. This method serves as a strong cross-check against the Gordon growth model and aligns with market-based valuations of comparable firms like O'Reilly and Genuine Parts. And then for the implied growth rate slide, to test the terminal value implied by the EV over EBITDA method, I calculated the implied perpetuity growth rate using the Gordon growth formula. Using a terminal value of $40.97 billion and a final unit free cash flow of negative $61.5 million from 2024, the implied perpetual growth rate is 6.55%. That's a high number for a mature company, and it's just that using a 12.3 times multiple assumes aggressive long-term growth. This analysis shows the importance of cross-checking terminal value methods and the risk of relying on a multiple without understanding what kind of growth it implies. In AutoZone's case, this tells us that conservative DCF assumptions may actually be more grounded in cash flow fundamentals. And moving on to my comparable company analysis. I compared AutoZone to several peers, including O'Reilly, Advanced Auto Parts, Genuine Parts, LKQ, and Monroe. I looked at 3 valuation multiples, and this was P over E. The peer average was 17.93x. EV over EBITDA was 12.3x, and EV over sales was 1.17x. And then AutoZone, in comparison, P&E was 24.2x, EV over EBITDA was 16.73x, and EV over sales was 3.88x. This suggests that the market gives AutoZone a premium, likely because of their superior margins and scale compared to other firms in their industry. The bar chart on this slide shows valuation ranges across multiples. These outputs help anchor AutoZone's value between roughly $13 billion and $30 billion, depending on the method. And then, just to kind of wrap up everything, Again, I used the full discounted cash flows approach and cross-checked it with both the terminal multiple method and a comps analysis. The DCF produced an enterprise value of $45.77 billion. The EV over EBITDA method gave an EV of $30.05 billion, and EV over sales gave a more conservative $12.99 billion. My base case equity value per share is $14.7308 based on the EV over EBITDA result. After correcting an early error in CapEx, the model became more realistic, which I kind of mentioned back on the previous slide. And in conclusion, AutoZone appears to be fairly to slightly overvalued in today's market, depending on the assumptions you use. But its premium, the reason why it's trading at a premium in the market makes sense based off of their strong fundamentals and just the industry that they're in and how they compare to their peers overall. Thank you for watching my presentation. And yeah, have a nice day.